This module will provide further details on when tax invoices and credit notes need to be issued for VAT purposes, as well as the information that needs to be included on each of these documents in order for them to be regarded as valid documents. This is important because failure to issue the correct VAT documentation, including invoices and credit notes, can result in financial penalties being levied by the Federal Tax Authority, FTA. A tax invoice, also commonly known as a VAT invoice, is a written or electronic document which records the details of a standard-rated taxable supply. A VAT-registered person or business must issue an original tax invoice to the recipient of a standard-rated supply of goods or services, or a deemed supply of goods or services. A tax invoice must be issued within 14 calendar days of the date of supply. It is, however, possible to issue a single tax invoice which covers multiple supplies made in the same calendar month to the same recipient. Where a supply is zero-rated, the supplier is not required to issue a tax invoice if sufficient records are available to establish the particulars of a supply. A tax invoice does not need to be issued for a VAT-exempt supply. Where the FTA considers that it is impractical for a tax invoice to be issued, it may determine that tax invoices, or certain particulars in tax invoices, are not required. Where a registered agent makes a supply of goods or services on behalf of the principal, the agent may issue a tax invoice as if they are making the taxable supply, as long as the principal does not issue a tax invoice as well. It is important to both suppliers and recipients of goods and services that they obtain and keep tax invoices that they raise or receive. This is because for suppliers, the issuance of a valid tax invoice is important, as it may dictate the time of supply and therefore determine in which tax period the output tax should be accounted for. For customers, on the other hand, the receipt of a tax invoice ensures transparency regarding VAT amounts charged. This is especially important for VAT-registered recipients, as a tax invoice is needed as evidence to support the recovery of VAT incurred on purchases as input tax. The previous slide explained the importance of tax invoices for both suppliers and customers. But how do you know whether an invoice contains all of the required information? To be valid, a tax invoice issued by a taxable person must include all of the following 11 pieces of information. The words tax invoice must be clearly displayed on the invoice. The name, address, and tax registration number of the supplier. The name, address, and tax registration number of the recipient, if registered. A sequential or unique number which identifies the tax invoice. The date of issue of the invoice and the date of supply if different to the invoice date. A description of the goods or services provided. For each good or service, the unit price, the quantity supplied, the applicable rate of tax, and the amount payable expressed in dirhams. The amount of any discount, if any. The gross amount payable expressed in dirhams. If an invoice is issued in non-dirham currency, the tax amount in dirhams and exchange rate must be stated. If an invoice relates to a supply where the recipient must account for reverse charge VAT, a statement that the recipient must self-account for the tax, and a reference to the relevant legislation. If an invoice does not contain all of the required fields from the list above, it will not be valid for VAT purposes, but note special rules for simplified tax invoices. The impact of this for suppliers is that the FTA can issue a financial penalty for the issue of an incorrect document. Recipients are not able to recover VAT charged to them as input tax unless they have a valid tax invoice. In addition to the requirements listed on the previous slide, where the place of supply of goods and services is in another GCC implementing state, the following two pieces of information are also required in order for the invoice to be a valid tax invoice. Firstly, the tax registration number that was issued to the recipient by the relevant tax authority in the implementing state, and, secondly, a statement identifying the supply as between the UAE and the relevant implementing state. A simplified tax invoice has fewer administrative requirements than a standard tax invoice. It can be issued instead of a normal tax invoice if it relates to either a supply made to a recipient that is not VAT registered, or a supply made to a VAT-registered recipient, but the consideration for the supply is not more than 10,000 dirhams. A simplified tax invoice must contain all of the following information. The words tax invoice must be clearly written on the invoice. A description of the goods or services supplied. Name, address and tax registration number of the supplier. Date of issuance of the tax invoice, and the total value of the consideration and tax charged. There may be instances where an invoice contains an error, such as where VAT has been incorrectly charged, where no tax was actually due, or where the wrong amount of tax was charged. If the tax shown on the invoice is higher than it should be, the supplier should account for the VAT amount stated on the invoice. If the tax shown on the invoice is lower than it should be, the supplier should account for the correct amount of tax, i.e. what should have been charged, on its tax return. However, in both instances, it will be necessary to adjust the errors through the issue of a tax credit note, where the amount of tax was too high, or an additional tax invoice where the amount of tax was lower than it should be. For example, ABC Limited charges tax of 100 dirhams on a supply to customer 1 and issues a tax invoice. 3 months later, ABC Limited realized that it should have charged 70 dirhams for the supply. ABC Limited should have accounted to the FTA for the originally charged VAT of 100 dirhams. Now it should also issue a tax credit note for the reduced amount and may adjust the VAT previously accounted for. In addition to the above, ABC Limited also incorrectly charged VAT of 200 dirhams rather than 300 dirhams on a supply to customer 2. ABC Limited needs to ensure that it corrects the error and accounts for the correct amount of VAT. A tax credit note is a written or electronic document which records the details of any reduction in the value and the corresponding output tax amount charged on a supply that has already been made, for example, a refund. When reducing the amount of output tax that was originally charged on a supply, the VAT-registered supplier must issue an original tax credit note to the original recipient of the supply. Where a registered agent makes a supply of goods or services on behalf of the principal, the agent may issue a tax credit note as if they had made the original taxable supply, as long as the principal does not issue a tax credit note as well. In order to be valid, a tax credit note issued by a taxable person must include all of the following 7 fields of information. Firstly, the words tax credit note must be clearly displayed on the credit note. Secondly, the name, address and tax registration number of the supplier. It must also show the name, address and tax registration number of recipient, if registered. The date of issue of the tax credit note must be stated. The value of the supply shown on the original tax invoice, the correct value of the supply, the difference between these amounts, and the tax charged in dirhams that relates to that difference. A brief explanation of the circumstances giving rise to the issuance of the tax credit note must be stated, and, finally, It must contain sufficient information which can be used to identify the supply to which the tax credit note relates. If one or more of these pieces of information is missing, the tax credit note will not be regarded as valid. A taxable person may issue a tax invoice or tax credit note electronically if both of the following conditions are met. Firstly, the taxable person must be able to securely store a copy of the documents in compliance with the VAT record-keeping requirements, and the authenticity of origin and integrity of the document can be guaranteed. Although typically a supplier is responsible for issuing tax invoices or tax credit notes, a recipient may be able to issue a tax invoice or tax credit note on behalf of the supplier if certain conditions are met. Such arrangements are permitted where all of the following criteria are met. 1. The recipient is registered for VAT. 2. There is an agreement in writing that the supplier will not issue a tax invoice or tax credit note for the supply. 3. The tax invoice or tax credit note meets all of the relevant conditions to be valid, as highlighted on the previous slides. And 4. For a tax invoice, the words tax invoice created by buyer, or for a tax credit note created by buyer, must be stated on the document. If a supplier issues a tax invoice or tax credit note after the recipient has already issued a self-billed or buyer-created document, the document issued by the supplier will not be treated as a valid tax invoice. For example, a VAT-registered seller of scrap metal may deliver scrap metal to the recycler. The scrap is then analysed, weighted, and then valued at the recycler's site. Since the exact value of the scrap is not known until these activities are performed by the recycler may be in a better position to issue tax invoices for the supply. A taxable person must retain the following records for at least 5 years from the end of the tax period to which they relate. In respect of invoices and credit notes, a taxable person must keep all tax invoices and alternative documents related to receiving goods or services and payments for them, e.g. receipts and relevant accounting books. All received tax credit notes and alternative documents received. All tax invoices and alternative documents issued, and all tax credit notes and alternative documents issued. In respect of other records, a taxable person must also retain records of all supplies and imports of goods and services, records of exported goods and services, records of goods and services that have been disposed of or used for matters not related to business, showing taxes paid, records of goods and services purchased for which the input tax was not deducted, and records of adjustments or corrections made to accounts or tax invoices. Finally, a taxable person must retain records of their VAT account, including the amount of VAT due on taxable supplies, VAT due on taxable supplies pursuant to the reverse charge mechanism, VAT due after error correction or adjustment, VAT deductible on supplies and imports, and VAT deductible after error correction or adjustment. Please note that it is a compulsory requirement for every taxable person to keep all of the records detailed above for at least the required time period. Any failure to do so could result in penalties being issued by the FTA.